Most people spend their entire lives chasing money. Charlie Munger spent his entire life understanding it. And there is a difference, a profound, life-altering difference. The people who chase money, they earn it, they lose it, they earn it again. They are always running, always anxious, always one bad decision away from starting over. The people who understand money, they build it quietly, protect it carefully, and watch it grow in ways that feel almost unfair to everyone watching from the outside. Charlie Munger was one of those people. Born in Omaha in 1924, he did not inherit wealth. He did not get lucky. He did not find a shortcut. He built one of the greatest financial minds in human history through decades of reading, thinking, and ruthless self-examination. By the time he died at the age of 99, he had accumulated not just a fortune, but a philosophy. A set of rules so clear, so honest, so brutally practical that most people who hear them feel uncomfortable because they reveal exactly where you have been going wrong. Today, we share 15 of those rules. Not motivational quotes, not abstract wisdom. Rules. Specific, applicable, and earned over a lifetime. If you apply even half of them, your financial life will never look the same. Rule number 1. Invert, always invert. Munger borrowed this idea from the German mathematician Carl Jacobi. Jacobi believed that the hardest problems in mathematics could only be solved by approaching them backwards. Munger applied this to money. Instead of asking, "How do I get rich?" he asked, "What guarantees that I stay poor?" The answer was immediate and honest. Spending more than you earn, carrying consumer debt, making decisions under emotional pressure, trusting people with misaligned incentives. Avoiding those things is not half the battle. It is almost the entire battle. Most financial failure is not the result of missing the right opportunity. It is the result of committing a preventable error. Invert first. Always. Rule number 2. Never risk what you have and need for what you do not have and do not need. Munger said this more than once, in more than one way. But the message was always the same. There is no return on earth worth risking your financial foundation. Not 20%, not 50%, not triple. The wealthy are not bold. They are calculated. They take risks with surplus capital, money they could lose entirely and still be fine. They never gamble with the money that keeps the lights on, the family secure, the business running. Before you make any investment, ask one question. If this goes to zero, what happens to my life? If the answer frightens you, the position is too large. Rule number 3. The first rule is never lose money. The second rule is never forget rule number 1. Most people attribute this to Warren Buffett, but Munger lived it just as completely. He understood something that takes most investors decades to learn. Losses are not symmetrical with gains. If you lose 50%, you need 100% gain just to get back to where you started. A 40% loss needs a 67% recovery. A 30% loss needs a 43% recovery. The mathematics of loss are brutal and patient. They do not care how talented you are. They do not care how confident you feel. Protection of capital is not the conservative choice. It is the intelligent one. Rule number 4. Show me the incentive, and I will show you the outcome. This is perhaps the most useful sentence Charlie Munger ever spoke. Every system, financial, corporate, political, personal, produces outcomes that match its incentives, not its intentions. Its incentives. Your financial advisor who earns a commission on every product he sells is not evil. He is human. His incentive is the commission. His outcome will follow that incentive whether he realizes it or not. The banker who benefits from your debt wants you to carry more of it. The platform that profits from your attention wants to keep you scrolling. Before trusting any financial advice, any institution, any system, ask one question. What does this person benefit from if I do what they are suggesting? The answer will tell you everything. Rule number 5. Avoid what Munger called the standard causes of human failure. He studied failure with the same intensity that others study success. He identified several patterns that appear again and again across financial disasters, large and small. Envy, resentment, self-pity. These three emotions, he believed, are not just morally corrosive, they are financially destructive. The person consumed by envy makes irrational comparisons. They take risks to match someone else's lifestyle instead of building their own. The person consumed by resentment makes decisions from bitterness rather than logic. The person consumed by self-pity cannot execute, cannot act, cannot build. Munger did not say eliminate these feelings. He said, do not let them sit in the driver's seat. Notice them, name them, then set them aside before you open your brokerage account. Rule number 6. Develop into a learning machine. Munger read for hours every single day, into his 90s. Not financial news, not earnings reports, history, biology, psychology, physics, engineering, law. He called it building a latticework of mental models. The idea was simple. The more frameworks you carry in your mind, the more ways you can analyze a problem. A person with one mental model sees every problem through that one lens. A person with 50 mental models sees 50 dimensions of the same problem. That depth of perception, that is where edge comes from. Not from a hot tip, not from insider information, from the accumulated wisdom of a lifetime of deliberate reading. An hour of reading today is not leisure, it is compounding. Rule number 7. Spend less than you earn, always, without exception. This rule is so simple that sophisticated people dismiss it. That dismissal is itself a form of stupidity. Munger was not subtle about this. He believed that the inability to delay gratification, the inability to live below your means, is the single most reliable predictor of long-term financial failure. Not market crashes, not bad luck, not systemic inequality, the gap between what you earn and what you spend. That gap is the engine. Everything else is noise. Widen the gap, protect the gap, invest the gap. That is the entire formula. Rule number 8. Compound interest is the 8th wonder of the world, but only if you leave it alone. Everyone has heard about compounding. Almost no one is patient enough to experience it. The mathematics are not complicated. Money growing at 10% doubles roughly every 7 years. But the magic only works if you do not interrupt it. The investor who pulls money out during a downturn does not just lock in a loss. He amputates the compounding curve. He removes years, sometimes decades, of future growth in a single emotional decision. Munger called time the friend of the wonderful business and the enemy of the mediocre one. The same is true of capital. Time is the friend of invested money. Impatience is its greatest enemy. Rule number 9. Only make big bets when the odds are overwhelmingly in your favor. Munger and Buffett did not diversify the way most financial textbooks suggest. They concentrated heavily. When they found an opportunity, they understood deeply. One with a wide margin of safety, a durable competitive advantage, and a price well below intrinsic value. They bet significantly. Not recklessly, significantly. Munger called it sitting on your hands 90% of the time and then swinging hard when the rare opportunity appears. The average investor does the opposite. They are always moving, always trading, always active. Activity feels like progress, but in investing, activity is often just the sound of money leaving your account. Wait, analyze, then act decisively when the time is genuinely right. Rule number 10. Understand the difference between a good business and a good investment. Munger taught Buffett something that changed everything. Early in his career, Buffett was a cigar butt investor. He looked for companies so cheap that even one last puff of value remained. Munger convinced him otherwise. A fair price for a wonderful company is better than a wonderful price for a fair company, because a wonderful company, one with durable competitive advantages, pricing power, and exceptional management, compounds value year after year. You do not need to sell. You do not need to trade. You just need to own it and leave it alone. Most retail investors never learn this distinction. They chase cheap stocks without asking why they are cheap. And cheap stocks are usually cheap for very good reasons. Rule number 11. The biggest financial mistake is not ignorance. It is the illusion of knowledge. Munger was more afraid of people who thought they knew something than people who admitted they did not. Ignorance is curable. False certainty is dangerous. The investor who says I do not understand this will not invest. The investor who says I understand this, when he does not, will invest heavily, confidently, and catastrophically. Munger kept a permanent mental checklist before any significant financial decision. What do I not know about this? What could make me completely wrong? Who is on the other side of this trade, and why might they know something I do not? Epistemic humility, the honest acknowledgement of the limits of your own knowledge, is not weakness. It is the most powerful risk management tool available. Rule number 12. Avoid debt that does not build equity. Munger was not philosophically opposed to all debt. He understood leverage. He understood mortgages. He understood that certain forms of debt, used to acquire assets that grow in value, can accelerate wealth building. But consumer debt, debt used to fund a lifestyle you have not yet earned? He considered it one of the most reliable paths to permanent financial mediocrity. The interest you pay on consumer debt is wealth transferring from your future self to a financial institution, every month, automatically, without mercy. He believed that a person who cannot live without consumer debt is not managing their finances. They are slowly surrendering them. Rule number 13. The quality of your decisions depends on the quality of your thinking, not the urgency of the moment. Munger said, I never make an important decision the same day I first consider it. 24 hours minimum. For significant decisions, weeks. For major capital allocation, months of analysis before a single dollar moved. The market will always create urgency. Earnings calls. Price movements, breaking news. A friend who just made a fortune. None of it is as urgent as it feels. The best investors in history were not fast. They were patient, thorough, and almost boring in their deliberateness. Speed is a virtue in many fields. In investing, it is almost always a liability. Rule number 14. Surround yourself with people who are better than you. Munger believed that you cannot rise above the average of the people you spend the most time with. Not as inspiration, as fact. Your financial habits, your risk tolerance, your spending patterns, your ambitions. All of these are profoundly shaped by the people in your immediate environment. If you spend your time with people who carry debt casually, who spend impulsively, who measure success by visible symbols of wealth, you will drift toward those behaviors, regardless of what you know, regardless of what you believe. But if you surround yourself with people who read deeply, think long-term, delay gratification, and build quietly, that environment will pull you upward. Choose your environment with the same care you choose your investments. Both will compound over time. Rule number 15. The goal is not to be rich. The goal is to be free. This is the rule that most people skip, because it redefines everything. Munger was not impressed by wealth as a scoreboard. He was not interested in the Forbes list. He was not building a monument to himself. He was building freedom. The freedom to say no. The freedom to work on what he chose. The freedom to spend his time in ways that matched his values. He called it a low-cortisol life, a life with low financial anxiety, a life where money was not the master of his mornings. The number in your account is not the goal. The freedom that number represents is the goal. And that distinction changes how you build, because freedom does not require the largest possible number. It requires the right number, acquired in the right way, protected with the right habits. Nothing more, nothing less. 15 rules. Not revolutionary, not complicated. Brutally honest. Charlie Munger did not discover new laws of finance. He simply had the discipline to follow the old ones, consistently, patiently, without exception, for nearly a century. And that is the final lesson hiding inside all 15 rules. It is not about knowing what to do. Almost everyone knows what to do. It is about doing it, quietly, repeatedly, long after the excitement has faded, long after your neighbor has moved on to something shinier, long after the market has frightened everyone else into making permanent decisions based on temporary emotions. That is the edge. That is the secret. That is what Charlie Munger understood before most of us were born. And now, so do you.